On the Money Watch, important news that affects all of us.
The Federal Reserve cut its key interest rate by a quarter point. The Fed also signaled fewer rate cuts next year. Wall Street didn't like the hint of just 2 rate cuts next year, sending stocks tumbling to their worst day in 4 months. The Dow dropped more than 1,100 points. The Nasdaq lost more than 3.5%, and the S&P 500 shed nearly 3%. I spoke to an expert earlier today about the Fed's decision. Joining us now to help us better understand what this means is CBS News business analyst Jill Schlesinger. Jill, thanks for being with us.
Great to have the opportunity to chat with you today.
And we appreciate you walking us through this. For those that aren't as financially literate, why is this announcement such a big deal?
You know, it's so wild because people are like, the Federal Reserve, it's so boring, why do I care? And yet, every single one of us is usually either a borrower or a saver. And that means that we are impacted by the Federal Reserve. We all interact in the economy. The Fed is supposed to be making sure the economy grows enough to create jobs, but also not by too much to create inflation. So we're kind of all touched by this in different ways.
How does this impact those of us who may have money in a CD or a money market account?
Well, when we see that 1/4 percentage point reduction, you know, it may be that tomorrow you wake up and you say, oh my God, my savings rate, it went down a little bit. Now, if you've already locked in a CD, that won't happen until you go to renew it. That said, you know, just a few years ago, when you looked at savings accounts, even higher yielding savings accounts and CDs, you were getting paid peanuts on those. So the fact that you're still able to get 4% on a CD or a high yield savings account or a money market, that's pretty good. So for savers, the news continues to be pretty darn good.
On the flip side, how does this affect those who might have a car loan or any other debt, like a balance on a credit card?
I think if we have credit card balances, there are a couple of ways to look at this. One is like, hey, thank goodness, any relief is good, right? Some small reduction in the percentage that I'm charged on that big fat balance or the small balance, that's going to help me. But that said, I went back and I looked at where the average credit card interest rates were back before the pandemic. And we were talking about 14 or 15%, high enough for sure. But today it's 22%. So even if it's going to go down to 21.25 or 21.5, you are still paying a much higher freight on those credit card balances. For an auto loan, you know, very few of us have adjustable rate auto loans, but if you're going to buy a new car, maybe it'll be a little bit cheaper.
And CBS News business analyst Jill Schlesinger. Jill, thank you so much.